We're doing 120 in a 65-mile-an-hour lane from 2020 to 2022.
Yeah.
Like, no one could keep that up. If it's so, I would buy a house right now. It's going to be worth $1 billion in 10 years.
Hey, everybody. Welcome to a special episode of the Landlord Lens. We're joined by a special guest here, Darius
What's
McClelland.
going on? How you doing?
Hey, man, we're glad to have you
Good.
on.
Thanks for having me.
We'll be talking here about the rental market in America, what Darius is seeing change in the Southeast. He's out of Silicon Valley, so he's got a lot of strong opinions about the difference between California and the rest of us, how that shows up in the market. But Darius, why don't you introduce yourself? Tell us how long you've been in rentals, how long you've been in real estate, where you come from. What's the bio?
Yeah, man. It's funny because real estate was the accidental path. I actually always thought I was going to be a physical therapist because I'm more of a sports background guy. It was actually a family in my baseball organization. You run a youth baseball training organization. The parent was like, "You need to get into real estate. Like, you have all these wealthy families that would love your help." He's like, "Just try it for 1 year." So in 2019, got my license. My first client was actually one of the lead engineers of LinkedIn. It was like within 24 hours of getting my license and signing with a brokerage, I sent an email out to everyone in my baseball organization. Was like, "Hey, I just got my real estate license. If you're looking to buy or sell real estate, I'm your guy." And then 24 hours later, this family's like, "We're trying to move to Los Altos Hills," which it's a very affluent area. It's where my office is. Starting home price now is you can't find anything under 4 million for a starter home in that neighborhood. Yeah. And so they were like, "Oh, we want to be in the hills." And I got them that deal. Actually, it was a steal. They got a 1,500 square foot home sitting on an acre. It was listed for like 3.4. We got it for 3.15. It was an absolute steal. I'm very aggressive. So like we got and saw it. That deal closed the day before the world shut down for the pandemic.
Oh, wow.
And yeah, crazy, right? And then after that, they forward clients. Then I had money saved up and I have a mentor, always get a mentor. And then he was like, "Hey, you need to start buying real estate because let's be honest, no one just likes giving their money away to taxes." And so he's like, "You need to start building wealth." And so I started social media, like learning about buying rentals. I chose to go the out of state route because I'm in Silicon Valley, where the starter home price in our market's about 1.5 to 1.6, and they don't make any money on the rental side. So I looked out of state, bought my first property in 2021, which was in Conroe, Texas, which is right outside of Houston. I love that property, still have it. And then after that, I just kept buying. And yeah, and now I'm a private money lender as well. So that's the bio of how I got into real estate.
That's awesome. So you're not only active as a deal maker for buying and selling primaries in Silicon Valley, you've also act as a remote buyer kind of in the rest of America where the deals make
Yeah.
more sense, and you're also lending money into deals as it
Yeah.
makes sense.
Yeah, that's the newest venture. I've been doing that one for about 2 years now.
Sweet. I bet that's a whole different feel to it because you've been in the seat of the person doing the stuff, right? Finding the deals, closing on
Yes.
them, making them cash flow, and now you're watching someone else do it with your money.
I love it. It's the most passive position in real estate. It's my favorite. I could talk about that one all day. Like that is I love it. I'm not stopping that. That's the end goal. Just keep doing it and doing it and doing it.
Totally. Awesome. Okay. So you've got all these different types of lenses to look at real estate in America, all of the markets all together, and maybe even you're in a good position to make some judgments or calls about the market in general, maybe,
Yeah.
or at least in a better position than someone who's insular in a single market.
Yeah, exactly.
So I guess my first question to you, with your perspective, how would you describe the current state of the housing market for rental investors like yourself and home buyers like your clients, especially when you're thinking of like the impacts on the buy and hold folks in the market?
Yeah, and so it's tough because outside the Bay Area, obviously, I'll break down to two. So outside, when you're looking at big parts of the country, like especially like the Midwest, you see interest rates really hit those markets hard
Yeah.
compared to where in Silicon Valley, interest rates, people are like, "Okay, I'm just gonna put more money down to lower my payment," whether it's a rental or an end user buyer. But interest rates, it made it hard. I was struggling to find deals. I mean, it took me once interest rates started climbing, especially in like the end of 2022 and in 2023. I cooled it on buying rentals because I could not find a deal that made sense. You really had to rely on connections to find deals, whether it's wholesalers or other investors that are buying aggressively. And you had to really niche down where it was like for Tennessee was a great example where everyone was buying in like Nashville. Rentals made sense, flipping made sense, everything made sense, right? You breathed, you made money in that market. But then with interest rates, it's like, home prices had risen so much more aggressively than rents had
Hmm.
that a lot of markets as a landlord for buy and holds, you got kind of the rent to price ratio, you got priced out.
Yeah.
And so you had to find different markets, and the markets that became the sexy markets were the ones that were like 30 minutes outside of any major area. Those areas still have really good numbers. So, like, if you look at Tennessee, there's a city called Johnson City. It's a really small city. Like, most people will overlook it. Great market because you could still, well, now it's balancing out a little bit, but you could find a home for 120, $150,000, but it would rent for 1,700, 1,800 bucks a month. And so because people hadn't migrated there yet, but they still had a good infrastructure, like it was, they still had hospitals and good schools. So they still had a good like micro economy. I like Memphis, Tennessee is another one that I invested in. That was great because, Memphis, Tennessee gets a lot of hate for crime and everything, but the rent to price ratio was strong. And there were certain zip codes within Memphis, Tennessee that were strong. But then now you're even there, you're seeing prices where it used to be you could buy a home for $100,000 and it would rent for 1,500 bucks a month. Now the homes are $150,000 renting for 1,500 bucks a month. But with a 6.5% interest rate, that's not making you any money. So now you have to niche down and look again into smaller markets. So that's where I've seen success and still seeing success for landlords and where I'm helping people like, where should I buy? Like, look at those smaller cities. St. Louis is still a great market right now where they actually, if you like Section 8, they just adjusted the fair market rents where they adjusted them. What was it last year? They were like outdated by like 3 years.
Wow.
So I own a home out there. It's like $100,000 and it's renting for 1,400 a month.
Gotcha. Okay. Wow. And it's a Section 8 home?
That's Section 8 home. Some people hate on Section 8. I love Section 8. It's guaranteed rent, low maintenance. The tenants stay long term, so it's lower vacancy. They don't want to go anywhere because they don't want to mess it up. You just got to know what you're doing and get in the right areas.
That's awesome. Yeah. Are you self-managing any of these remotely?
I have so I use TurboTenant for my Texas one. That was my
Okay.
first. That's my baby.
Nice.
That's the first one.
Okay.
And I have a property manager that I inherited with the two I have in Memphis, Tennessee. I'm actually in the process of selling those because I want to use more money to private money lend. But the St. Louis ones, I'm actually going to be hooking those up with TurboTenant as well. They
Nice.
just renovating and put tenants in.
It sounds like the property manager, you're even as a remote landlord, you're still taking a self-management posture
Yeah.
towards those rentals.
Yes. Honestly, I like managing it myself over having a property manager and
Yeah.
as well. Like, especially with TurboTenant, I'm not saying this because we're on a TurboTenant thing on a podcast. It's just makes everything so much easier. I can get things done so quickly on my Texas rental. Like my Texas rental, I'd spend maybe an hour a month managing it.
Wow.
Yeah. In the turnover process, I use the leases that you guys have and everything. And everything is through that. So I spend not a lot of time managing it. I'm a big fan of self-managing properties.
That's awesome. Very cool to hear all that. I think if I'm putting myself in the seat of someone listening who's thinking about, man, it sounds awesome to be able to get into these out of state markets, but as soon as I start factoring in that 10%, I think the property manager is going to cost, it gets hard. They're telling themselves this story of how, why not to actually put money out there and invest in these things. I'm imagining them watching this saying, well, yeah, but how do you really deal with like a vacancy with nobody on the ground? Do you fly out to deal with that, or do you handle those? Yes, sure. How you deal with vacancies in these properties?
Yeah, so I have a realtor that helped me buy the property in Texas, and I use her to show the property, and that makes it easy. It's like, yes, I am technically giving away 1 month's rent as a commission
Yeah.
for her doing it, but it's so worth it. And that 1 month rent, I mean, the mortgage becomes a write off because it's a loss, so it's okay.
Yep.
But it's so worth it because she can do the showing, she can let me know what she thinks of the tenant, and I obviously do the background checks with the credit report and everything. I do a video interview like face to face
Yep.
virtually?
Yep.
And that's pretty much all I need. I have a boots on the ground team as far as I have connections with the handyman and anything I need for fixing an AC or something like that. I actually use an app called Thumbtack as well,
Nice. Okay.
which I actually really like that app because you can get someone out there in 24 hours if you need anything else.
Yeah.
A lot of the times is I tell people if managing your property remotely is not as hard as everyone makes it seem, the greatest thing is connect with an investor friendly realtor and they'll give you all the connections you ever need. Like I'm an investor friendly realtor, so I give my clients out here in Silicon Valley when they want to buy rentals,
Yeah.
I give them connections to everything. I was like, anything you need someone that needs to flip the house upside down, I got you. That's the hack.
Gotcha. So connections, making sure there are people on there, and that the cost of managing those people actually makes sense. That 1 month rent, right, is one of the costs that makes sense. So you don't have to hop on a plane to do this.
Yeah.
We've talked a little bit about this, and I know a lot of landlords are talking about. I mean, America's talking about it, and that's the affordability question. You talked about the interest rates rising and how that's impacting families' cash flows, right, as they're looking of moving, upgrading, getting more space, whatever. Or even just, your one bedroom home might be much more expensive than it was 5 years ago. Do you think we're at a point where this is improving? Do you think it's staying flat, getting worse? Like what should we be what's the forecast for 2026 from your perspective as you're looking at the market every day?
Yeah, it's interesting, right? I mean, we're not genies, but at the end of the day, when you're looking at the market, I think home affordability is going to get tougher. I really do. I think it's just the way there is. There's more money out there. We're getting a lot of, especially we're seeing it out here, as we're getting a lot of foreign money.
Yep.
I like to look at it as I do think Silicon Valley sees a lot of things first, and because we get a lot of foreign money, especially in tech, and then people from Silicon Valley start moving to other states and rising the home prices. I mean, if you look at Utah, you go to Utah, you go to Denver, it's like you turn around and say, "Oh, where are you from? California. Where are you from? California." I say California is a driving force of making everyone's real estate expensive more expensive. But they're trying to do some things like the 50-year mortgage, which we can get into later. I have a whole lot of opinions on that one.
Okay,
Um,
excellent.
I don't think home affordability is going to get much better for the foreseeable future. I think people are going to have to be very disciplined with their finances to be able to get in a home, because even though home affordability is getting harder, people are still buying homes. It's not like our market has crashed.
Right.
I tell people our market from 2020 to 2022 was like doing, if you're on a freeway, it was like doing 120 miles an hour in a 65-mile-an-hour lane. And then right now, we're just doing a 65 and a 65, where we're in a more normal market. Everyone's freaking out about, oh my God, like the market's slow. It's like, no, we've just gone to a more normal market where there's room to negotiate.
Yeah.
And you have to actually properly prepare your home to sell if you want to get top dollar. I sold a home for $500,000 over ass earlier this year, right? With 17 offers.
Yeah.
And so
Yeah. That's what's happening.
it's like the good homes still sell. And as far as if you're an investor, I think right now is a fantastic time to buy if you're buying real estate, because you buy while other people are scared. And so you have more power to get good deals. And there's people that really do need to move. And they're not taking advantage of people by like, oh my God, I'm gonna lowball you on your home because you're desperate. There's people that are really trying to better their situation, whether they're downsizing or they're like, hey, I no longer need my home in, let's say, in Memphis, Tennessee, that was a nice 3-bed, 2-bath that could be a good rental. And they're like, look, we're just moving somewhere else. Or it's a lot of people, there's a lot of investors selling off their portfolios right now that are just retiring. I think there's a huge market for people to buy tired landlords properties. Right now is a fantastic time to do it, because you have a lot of people who've been doing it for a long time and they're just like, you know what? I don't want to keep dealing with tenants anymore. I'm done. And I bought my properties off of tired landlords.
Mm.
And so, yeah, there's going to have to be some drastic changes before our market becomes more affordable, I think. And I think that's across the country.
I've never heard that term "tired landlord" as a
Yeah.
seller profile, but I love that. I love that. I've talked to some tired landlords. I knew I had people come to mind when you said that. That was awesome. You mentioned some drastic changes, and we'll talk about the 50-year mortgage and some of the policy proposals in a minute. But does anything come to mind of an actual realistic but still drastic change to our market or local markets that may make things more affordable realistically?
It's going to have to be that interest rates come down. But even when interest rates come down, home prices are going to spike.
Right.
And so that's why I look at it as a double-edged sword. I think, either life is gonna have to keep getting more expensive so that people stop spending money and home prices come down, or it's gonna have to be that money becomes more affordable and then people are somehow being able to pay more for homes. I don't like saying I'm pessimistic about home affordability, but I also just don't see the foreseeable future of what can make things so much better. I see that, they're trying and finding ways to lower monthly payments is a start, but everything comes at a cost. I think you give out money, inflation happens.
Yeah.
And so it's like you have to have wealthy, middle, and lower class. That's just how it has to be for money to cycle.
Right.
And I have this talk in our office all the time with other realtors, and everyone's scratching their heads like this. Like, I can't even tell my clients like, hey, it's gonna get better. You almost have to wait for something catastrophic to happen, so where people are gonna stop spending money.
What do you think about the supply side arguments some people make about part of the reason California is so expensive is they're building less homes relative to the population that's coming of age? I mean, is there an argument of policies in that direction? I don't think that's going to fix things overnight, obviously, but
It's gonna take time.
yeah,
Like let's say, right? Supply and demand. Like
yeah,
it's
yeah,
having more supply always helps. But like we've seen in certain markets like Texas, they're like Austin and Houston, their markets softened because a lot of new builds started to be built. But then on the vice versa side is like you still see is like their population is still growing.
right. We're just keeping up.
It's a short-term fix, but it is also keeping up. It's like even Silicon Valley softened because people were paying ridiculous amount of money for their homes.
And
So anything's going to soften from that, right? Like I said, we are doing 120 in a 65-mile-an-hour lane from 2020 to 2022.
yeah,
So like I said, when people say, "Oh, the market softened," I'm like, "Yeah, but like, is it really softening? We were like in an unrealistic market for a couple of years. Like no one could keep that up. If it's so, I would buy a house right now. It's gonna be worth $1 billion in 10 years."
yeah,
So supply helps, but at the same time, is we're not seeing so much supply because we have also tariffs coming in place, which puts a strain on the cost of wood and everything. And so then builders can't build homes, or if they are building homes, they're just going to be more expensive. So again, it's like that's where I say it's kind of double-edged sword. It's like, okay, at what cost? Because you're going to build a new home, but now that new home is costing 10% more to build.
right.
You're still have a more expensive home.
Interesting. Basically, the places that have enacted local policies that encourage building are also growing. So it's hard to tell what the actual impact is because
Yes.
everywhere's softening at the same time. So it's challenging to see how fast any of that might even impact housing prices in the long term, especially when the American dream still is a single family home, right? And it's a lot easier to build apartments and condos for a lower cost per unit than it is single family, but everyone wants a single family.
Yeah.
This is America. Um,
Yeah. Everyone wants their own yard, right?
exactly. Somewhere for the dog to go.
Exactly.
Okay. So let's pivot now and talk about the proposal that we've been alluding to a little bit, which is this 50-year mortgage. There are some other proposals from that we can comment on too, like when the first 3 months of the new administration, they put out a map of areas that are federally owned that they wanted to build homes on. I
Yeah.
don't know if you saw that map. It was like the middle of the desert in Utah was on that map. It's like, oh yeah, everyone's gonna move to this is the Hills Have Eyes development. Yeah, I mean, there's a lot of interesting and strange proposals, which is exciting because it shows some dynamism and recognition of the problem. But they also seem like they're flawed, and so it sounds like you have some opinions about the 50-year mortgage, and I'd love to hear those.
Yeah, so I'll be honest, like when I first about heard the 50-year mortgage, I was like, this is the dumbest idea I've ever heard. Like that was my initial thought.
Yeah,
Like that's like lifetime debt, right? When
yeah,
it's like, let's say you live 80 years, that means, and you're probably not buying a home till 30. I was like, you're never gonna live long enough to see your home paid off. But as you do more research and you think, I do say it is what you make of it. I said that I think the biggest winners in this, besides banks, are landlords, because a lower monthly payment means more cash flow.
yeah,
So as a landlord, I think you can win with this because it doesn't necessarily mean you have to keep the home for 50 years. You can sell it in 1031 exchange into another property after 5, 6 years where you see enough appreciation. But again, what I also say about it is I think if you want to do a 50-year mortgage to get more cash flow, you also have to buy it in markets that you have a good equity play too, because you're going to be paying so much more in interest over time. Where technically, if you're buying in a market that doesn't appreciate at a certain rate, you're technically overpaying for the home down like long term. So when you try to sell it, you're not gonna get that return that you want on it. So where it's like, okay, I want a 1031 exchange into something. Or it's like you could technically like break even if you look at it down the road. But it's a great short term, like, oh, well, guess what? My monthly payment went down $300 a month. So now I'm taking home $300 more a month. So I see landlords winning in this. As a home buyer, I think a lot of home buyers don't look at their home as specifically as an investment. It's a home, so they don't care as much. So for the people who are like, hey, this is a long-term home for me, it's not a bad option because now it's like this is a more affordable home.
yeah.
But what I also say is too is like, your average home buyer stays in a home for like 5 to 7 years. So you have to make sure that if you're buying in a certain market, in 5 to 7 years, did your home appreciate enough where it can pay down the 45 more years of interest? So that's kind of how I said. I actually made a joke when it came out on Instagram, and I was just like, if you're looking at a 50-year mortgage, I was going after the parents, like parents, this is for you of preschoolers that you better tell your kid in preschool they better buy now. Like they need to sell their snacks. Stop playing around the playground. The playground is now. You need to be the cartel of snacks. You need to start selling that stuff, and then you know how you have your crush and you push them on the swing. You are now charging your crush per push, $20 per push because you got to be able to save money to buy buy a home by the time you're 10, so you can live long enough to see it paid off. So it is what you make of it.
Yeah.
I really do think the 50-year mortgages, you have to think about it as where you're buying. Like for people in the Bay Area and Silicon Valley, it might not be the end of the world because we appreciate such a high level. I mean, there's some homes that are appreciating 100, $200,000 a year. Like
Yeah.
one of the buyers I helped out, my first client, they bought that home for a 3.15 and it appreciated over about $800,000 in a year.
In a year. That's
So
absurd.
a 50-year mortgage isn't going to hurt you there.
That is wild. And I think one of those graphs that was going around was about the amortization schedule. And it goes into what you're saying here that those first, 5, 10, 15, 25 sounds ridiculous to say, but you're still making mostly interest payments during that period, which when you're talking about paying down the loan, if you're simple like me and you're sitting here and you're thinking, okay, if I get a 5% mortgage, that means it needs to appreciate 5% every year for me to break even. No, 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 because there's the interest payments that are mostly what you're actually paying for those 5 to 7 years an average family lives in a home.
Exactly.
So you're not paying down the mortgage actually, you're paying interest on it.
Yeah, exactly. Like that's what I'm saying. The interest you accrue on a 50-year mortgage is insane.
Yeah, absurd.
It's
It's
like
huge amount.
that's a lot. That's why I said I technically you could be overpaying for a home like long term if you technically don't buy right. I think buyers are gonna have to think more like investors with the 50-year mortgage.
Yeah. This has got a lot less headlines, but, it has been, proposed by different politicians, and it's this idea of a more portable mortgage, which is tied to yourself, but the debt can travel and be used to purchase additional homes at the same rate. Have you heard any conversation about that, in the market?
Just a little bit. I was reading about it because I actually like saw it like a couple days before this, and I was reading about it, and I'm like, so it's almost like a playoff of pay taking an assumable mortgage.
Yeah.
Uh,
You bring it
and
kind of? Yeah.
yeah, you bring it. So like it's again, I see that what they're trying to do because it's trying to help people that are like, hey, look, you have a low interest rate. You don't want to be locked into your home, feel like you're stuck in your home, in your current home. So it's trying to get people to be more flexible and being willing to sell. But the only issue is like, let's say you get a home, and then I would feel like you'd have to take a second mortgage on a home when you transfer it if the home is worth more than the home that you're selling.
Right, so you have 2. You have this one that you bought and the other.
Yeah. So again, the biggest winner, ding, 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 banks,
Yeah.
because, and I might have to just read up on this more, is about what are they going to do for the people? Let's say I buy a home for 1 million and I had a 3.5 interest rate. Now I'm buying a home that's 1.8 million. I sold my current home and I'm buying a $1.8 million home, but there's disparity. And then with the portable mortgage, they said you have to pay the difference. So are you saying that now this person's going to have to just come out straight cash with the difference, but keep their original
Yeah.
loan if their original loan isn't paid off? Or are we talking about, okay, now we're going to have somehow combine, like we'll pay off whatever is the $1 million home gets you for the 1.8, and then you have a mortgage on that. Does your interest rate somehow get affected? Is there a second loan that gets?
Right.
That's where I think they're going to have to really clarify because I think people can get themselves in a lot of trouble and a lot of debt. And I'm not saying, the government's always trying to screw us, but let's be honest here. At the end of the day, the banks want to make money.
Yeah.
That's why I became a private money lender. Being the bank beats the bank any day of the week. Uh, and so, I think that there's somehow, the banks are still going to win. People are going to be paying potentially maybe more than they normally would have if they just would have gone the original route.
Gotcha. Yeah. So basically, what you're saying is, depending on how they translate that debt that they're bringing in into a higher value home, whether that's two loans stacked on each other, whether that's a combined loan with a negotiated interest rate, there's a lot of different ways this could play out. But a lot of those scenarios could result in a home seller and home buyer, the person bringing it, in a much worse position than they would be if they just bought it the 6% on market or something like that.
Yeah, exactly. And again, I could be wrong. Like, I mean, it's such a new concept. I mean, they just talked about it, what, like a week ago?
Yeah.
And it's so quiet. It was just like hush, like, hey,
Maybe this works.
let's get this in there. And let's see what happens. It's like I feel like that's how like California does all their laws. It's like all like they just like slip it in there, and then we're like one day we're like, what? We didn't vote for this.
I mean, I think in both of these cases with the 50-year and the portable mortgages, the idea is to basically free up movement in the market and increase
Yeah.
inventory in what in the weight of COVID and 2-3%, the zero interest rate environment, right? And how that impacted homes. Folks will feel locked in, like they can't move. What would that liquidity mean for investors in the country generally, but also in the rental markets that we've been talking about so far?
I mean, liquidity is everything, right? I mean, if you equity liquidity, I like to say like people want to talk about liquidity. I talk about equity. I think that's just a huge thing that it's such a powerful tool, and I actually think the people who have equity in homes right now are the ones that are gonna win the most out of anything. I think the people who are in the best bet to succeed in the real estate market, whether you're an investor or an end user being someone that just moves into the home and live in it, it's the people with equity because equity gives you flexibility because equity is liquidity. Because it's like you don't have to sell a home to buy another home, or if you're an investor, you could take equity out and use, especially out here in Silicon Valley, right? You have a $1.6 million home, you could take out $200,000, and that's nothing as a loan out here, and you could buy two properties in another state, cash flowing rentals. Whereas like in other states, it's like you could trade, if you have equity in your home, you can trade it, sell it, and you're going to come home with a lot more. And I call it the stepping stones to move up your home, like, to get, as I use each home as a stepping stone to get to your dream home. And as an investor, I think equity is a huge play. As in, I think people who are looking to get into real estate right now, like let's say you're average person that's sitting in a home and you have equity in it and you're looking to buy a home. I would use your equity in your home if your home value is enough. There's enough
Yep.
equity in there. I was like, hey, use some of that equity, especially if you have a home you don't want to move out of anytime soon, and use that and go buy real estate. I think it's a tool that people don't use enough.
Yeah. Yeah. I think you're right. Folks stay locked in or refinance and feel like they can't move it. But there are ways.
There's ways. And so I hope that answers your question, kind of like what the point you're making.
Yeah, I mean a little bit because one I guess the weird thing about all of these that would in theory create more inventory in housing of the portable mortgage or the 50. I mean the 50-year actually would not probably necessarily create more inventory, but the portable mortgage would because it
Yeah.
would make people with that 2% feel comfortable putting their house up for sale. Whereas there's some set of homes that would sell if you could take the 3%.
It would stimulate the market more if that was possible. I mean,
Stimulation would actually drop prices, right?
it would. It's like, well, it can and it can't, because stimulating in the market. I mean, we saw how stimulated our market was in 2020 to 2022,
Yeah,
and our home prices
true.
spiked
Yeah,
because they, by getting a loan was basically free. so
yeah,
but movement does help, and that's the problem that we've had for years, is like there's less movement, and a lot of it is just, it's gonna have to be a mindset shift. Is a lot more people can afford homes. It's the mindset, I think, that imprisons people most, is more than anything. Like, people are sitting in their homes and they're feeling trapped in their 3% mortgage, like you were saying. And I speak on this on the realtor side first, because I think I see it more closely as a realtor than an investor. When I talk to my clients who are like, I want to sell, but I'm stuck in this 3% mortgage, this interest rate, and I don't want, like, they're imprisoned by it.
yeah,
And I'm like, but you got to look at it this way. How much equity do you have in this home? And you're going to have that talk with them of like, you have enough equity in the home that you could buy this next home and pay down your interest rate to where it's almost the same as having your 3%, because you could put over 20% down
yeah,
because you have so much money that's going to come from this home. I think America needs a mindset shift of, your people are imprisoning themselves. I mean, obviously the people who bought like within the last year, like,
yeah,
you're stuck with a high mortgage rate, but whatever. But the people who bought, and even 2020, if you bought an appreciating market, you probably have enough equity where if you wanted to move, you can. They just have to understand is that you're not married to the mortgage rate, and we're not going to see 3% again. I don't think we're going to see that in our lifetime.
yeah,
So I think people need to get that out of their heads. I had talked to so many people and they're like, hey, well, I'm just going to wait till rates come down. I'm like, okay, till what? You were complaining at 7, you're complaining at 6. You're going to get off the bench and get in the game or what? Because, or you're going to sit there and complaining all the time. I mean, you have to at some point just say, hey, I'm going to take this interest rate and then eventually I can refinance.
yeah.
And maybe you might only refinance from a 6 to a 5. That's still a big difference. But home affordability, yes, it's an issue, but I also think we have a stuck mindset.
Yeah, that's true. I think it's comfortable to tell ourselves stories of why we're stuck.
Yeah, you're 1,000% right.
Yeah,
It is a mindset, and people, listen to the news, and the news is the art of installing fear.
yeah,
That's what the news is for. So it's, and people are like, oh my god, this and that, and the people that I've helped actually buy homes right now, I'm like, hey, you have this flexibility. They've done it. They have called me and they're like, thank you,
yeah,
because they thought that they were imprisoned to this. And then on the investor side, I mean, buy real estate right now. Like, if you're into buying real estate, buy it. It's a great time. This is honestly the time we've been looking for to buy as investors when other people aren't.
yeah. I've wanted to ask you this since the beginning of the conversation when you shared Johnstown and Tennessee as an example. Obviously, you're hearing pitches on specific deals from folks now that you're in private money.
Yeah.
I'm curious, where are the markets that are kind of sleeper markets that you're hearing about from your activities, but you're not seeing in the headlines? Where are the opportunities that you're seeing?
St. Louis, I think, is one that people talk about but don't talk about enough. I mean, the rent to price ratio is still insane. I really like it. The stable market, the tenants are great. And then again, and especially if you're a Section 8 person, if you like Section 8 rents, that's a huge calling. And I know a lot of people are like, oh my God, well, Trump was, defunding Section 8 and stuff like that. They're fine. So it's, I really like that market. I like Conroe, Texas, 30 minutes outside of Houston. That's where I bought my first rental. I've actually just talked to a couple people about that. They're like, I was looking into that market that you mentioned it. I really like that one. It's, some of the homes are actually somewhat newer. So the home I bought is a 2009 build.
Oh wow.
So it's great, right? Talk about longevity in the home. You might have to replace like the AC and stuff because 2009, but at the end of the day, the home is in great shape, 2009. So that's another great market. Still, some or certain parts of Memphis, Tennessee are good. I would just stay north of the 38110 zip code. So you go higher than that and then stay away from 38127. So like there's like some niches in there. Here's one market that people don't talk about enough. Gary, Indiana.
Really?
Gary, Indiana. Yes.
You're gonna say Gary, Indiana?
Gary, it's people used to crap on that, and I did too. I was the one that was like, no, that place is terrible. Like, absolutely not. They've done so much. Like, I mean, it's gentrification, right? Like, that's what's
Sure.
happening over there. And for the people that know, it's like, they're making it nicer. Like, that's the way, that's the quickest way to put it. I know it sounds terrible, but I just say it. It's revamping. And you can buy a home there for still under $100,000 and it'll rent for 1,500 $1,500 a month.
Oh,
I looked at that market first when I first was looking at real estate, and I was like, absolutely no way. This house looks like if you huff and puff, it's going to blow down. But you get a lot of people that work in Chicago that live in Gary because they're so close, like 30 minutes out. And that's like a little pocket that only a couple people talk about. And there's a lot of opportunity there. And that's a great place to like buy, renovate, do the burr strategy because you can still do a cash out refinance and get the ARV, and the ARV doesn't price you out of having cash flow, even with a high interest rate.
I'd never thought of Gary, Indiana as basically a commuter city for Chicago, but
It
it
is.
is.
That's
Yeah.
what it is. It's like a lot of people that work in Chicago, they live in Indiana
Yeah.
and it's stable rents. I've watched that market. The home prices haven't done a lot of this huge swing like a Texas and Tennessee is because it's not the sexy city. Kentucky is another good one, not a sexy city. That's great for multifamilies right now because Kentucky, I feel like they have more multifamilies and single family homes out there, especially like Louisville. Frankfurt, they like fourplexes. I'm a big fan of you go look for fourplexes. There are 2-in-1 layouts, so 2 bed, 1 bath. Don't go for the 1 bed, 1 bath because the rent to price ratio just doesn't work out. Because I will say the home insurance out there is crazy expensive. Yeah, when I was running deals, I actually backed out on a deal in Kentucky 2 years ago because for a $280,000 fourplex that was going to bring in about 4,000 a month in rent, they wanted 5,000 for insurance. I got 3 quotes, $5,000.
Why? What's going on in
I
Kentucky?
don't know. I don't know. And I was like 5,000 pesos. like, like, what are we doing here?
Wow.
Yeah, it was insane. But they had a huge spike during the pandemic because everyone was in real estate during the pandemic, whether you're a realtor or investor.
Yeah.
But then what happened was, everyone was buying for astronomical amounts. Like I kept getting outbid. I'd be like, oh, this one's listed for 275. It makes sense for 275. And then someone would come in and buy it for 315. And I was like, what? And then now I see that same thing back on the market.
Yeah.
And so it's the right now, that's a great place to pick up fourplexes. Wisconsin is another good one. I don't look at Wisconsin too much, but I know that there's some pockets in Wisconsin. Ohio, there's some pockets.
Is it the same rule you kind of follow of draw a line 30 miles out in any direction and see what's there?
Yep. Yep. Kentucky, Louisville, Kentucky is a major city.
Yeah. St. Louis, like you said.
That's a good market. It's good for flipping and it's good for rentals. I think that one has proven that they've been good since I looked at it in 2020. One of my friends actually told me about it. They're like, hey, you should look at this. And I took a look and I ran numbers. I was on Zillow like every day. Like I would probably analyze like 30 to 40 properties a day.
Just
Hence why I'm tired of money lending now because I'm tired of doing that. Well,
yeah.
but I think again, look at a city or a state that has a reason for people to move there. Like follow tech. That's a great way because tech is moving to all over because it's too expensive to keep running them in California and Silicon Valley. And then say, hey, let me just people will drive 30 minutes from their job. It's not sexy. Non-sexy real estate makes the most money. Okay. It's the most stable. It makes the most money in the long term.
That's right. Yeah. That was awesome. Thank you for dropping some of those. I hadn't even thought about we have some users in Milwaukee who are pretty active. So I've got a feel for Wisconsin, but I've never like dug in. So that's a
Yeah.
very interesting one for me too.
Yeah. It's interesting, right? Like the markets you would never think about are the ones where investors go.
Yeah.
Then people follow.
Awesome. Darius, thank you so much. I want to invite you to plug your socials. I know you're very active there, and make sure people know how to reach out to you.
Yeah, best place to reach out to me is on Instagram. My Instagram is invest with Darius. I can't stand my Instagram name, but I'm not changing it. So that's the best place. I'm on there every day. I run my own account. I'm a big believer in making things personable. So like I like being the person that runs the account. So like if you DM me, I'm the one that responds. And then from there, you can get access to my newsletter. It's free. I don't have any courses or anything like that. I just offer free knowledge because I was very fortunate to have people who offered information for free to me. So I just like paying it forward. And so Instagram Invest with Darius is the best place. I'm there every day. That's my home.
Darius, thanks so much for hopping on and spending some time with us and sharing some of your experience. And everybody, if you liked Darius, you can reach out to him. Invest with Darius on Instagram. He's on there every day. He just told me. Uh, and yeah, like and subscribe. And yeah, see you guys next week.